Welcome back, everybody. This is video number 3 of how to understand and analyze financial statements for small businesses. If you have not looked at our 2 other videos on the balance sheet and on the income statement, also known as the profit and loss statement, then please go back and take a look at those, because some of the information in this, particularly for the statement of cash flows, from those videos is going to be very relevant here. So please take a look at those. We've divided these into 3 so that you can absorb this information when you need to, or you need a refresher, and it doesn't overwhelm you all at once. So our final statement is the statement of cash flows. And you might have recalled that in our first video, one of the number 1 reasons that small businesses fail is not understanding cash flow. So we're going to dive into that and help you understand what the heck is going on. So a cash flow statement is measuring cash, or is mapping cash in and out of your bank account. And the reason that this is so important is that just like the water that goes into a root system for a tree, if that dries up or it's at a trickle, it can really affect the health of the business. The whole thing can collapse. Once you don't have money in your bank account, you're pretty much done. So the first question that people ask is, isn't that what the profit and loss statement is showing me? And the answer to that is almost, but not quite. And what the statement of cash flow does for us is helps us unravel that mystery. I have had people say, hey, I made $50,000, $60,000 in profit, but I only have $20,000 in my bank account at the end of the year. How did that happen? This is the answer to that question. So the first reason that this can happen is if you're only looking at your profit and loss statement, that's not showing you everything that went through your bank account. As you may recall from our first video, there's 2 financial reports that get generated from your financial system that have accounts on what's called a chart of accounts. It's a list of categories that we categorize every financial transaction with, and it ends up on either a balance sheet or a profit and loss statement. So if it didn't happen to end up on the profit and loss statement, but you use cash out of your bank account, then that profit number is not actually telling you what's in your bank account. So we have to untangle transactions that are on a balance sheet versus on a profit and loss statement. Another big reason that this happens is, as you may have recalled from past videos, we have an account called accounts receivable. That's an account we use for businesses that give products and services to other people but don't make them pay for it when they're in front of them. They send them a bill later. And we use the example of a contractor who goes into a local hardware store, knows the owners, has a house account, buys thousands of dollars worth of stuff, and the business owner records it as a sale that day because the stuff left the store. It was a sale. So that ends up in your revenue number, but you haven't actually gotten paid for it until you send that invoice and the person sends the money back. So cash did not go into your bank account because that revenue is on your income statement. Accounts receivable is the thing that tracks whether how much money people still owe you. And the flip side of that is if you're the contractor that goes into the store and you buy a bunch of stuff and you go back to your office and you've got a receipt, you want to put that into your accounting software program because it's an expense that you just had, even though you haven't paid for it yet. And we want to keep track of that. But money, even though that expense showed up on your income statement, your profit and loss statement, the money hasn't actually left your bank account yet. So what the statement of cash flows is going to do is untangle this very confusing topic so that we can understand where the money is going and flowing to and how it's coming in. So the way it works is we actually start with the result of our income statement, our profit and loss statement for the time period that we're running this on. And as you may recall, my business made $61,500 in profit. But then, because that doesn't mean that it's $61,500 or $61,500 in cash, we go through a process to figure out what the cash part of this is. So we know that we have $5,000 on our balance sheet in accounts receivable, money that people owe us for. We already booked that as revenue, so it's getting reflected in that 61,500, but we didn't actually get the cash. So we're going to back that number out. The flip side is that we recorded an expense when we went into our hardware store, and we have $5,000 in expenses that's reflected in that 61,500, but we actually haven't paid the bill yet. The money's still in the bank. We're going to add it back in. Same with the credit card. We have $10,000 in expenses that we used our credit card to buy, but we haven't paid our credit card bill. Money's still in the bank. We're going to add that back into our profit number. So now we're looking at a situation where we had $61,500 in profit, but we've actually got $71,500 sitting in the bank after we untangle the operating part of this statement. That was that part of the statement. The next part of the statement is anything related to investing in the business. So in this case, we bought $30,000 in equipment. And as you'll recall from our conversation about the balance sheet, that's an asset of the business. It's not an expense that happened to run the business that year. Expenses are things that get used up in a year. Equipment investments are longer term assets, and but they're not reflected in that $61,500. But $30,000 went out of our bank account to buy that thing. So we're going to take that out of our cash calculation. So now we have $30,000 less in cash. And then depreciation is a non-cash expense. And what that means is the IRS says, okay, you bought a big asset, but we know that each year that asset loses value, like a truck. The more you drive the truck, the less it's worth. So each year you're allowed to take what's called a depreciation expense to reflect that loss. And we want to take it because it reduces our taxable profit to the IRS. But no money actually left our bank account. So we are going to add that back in because no cash left the bank account. So between those two investing activities, we see that we actually lost $18,000 in cash due to those investing activities. So then we go down to the third and final section, which is financing activities, which are things that happen in the business to finance when we take out debt, or an owner takes out money or puts in money. So in this case, as you may recall, we have a mortgage, and when you have a mortgage, there's two parts of it, of each monthly payment. You pay principal, which is paying back the debt itself, and we pay interest. Interest is considered an allowable expense by the IRS because it's the cost of running your business. That's reflected in our $61,500. The principal portion of that payment is not. That's a balance sheet account. You're just reducing the debt as you pay it down. But cash for principal left our bank account and is not reflected in our income statement. So we need to take out $25,000. Our owner also took out some money. Oftentimes with small businesses, owners are not employees of the business. The way that they get paid is just through the profits that the business generates. So owners can take money out. It's not an expense of the business though, because it's affecting the equity position. Remember, it's that part of the business that is completely belongs to the owner. So they took out $20,000. It's not an expense. It's not reflected up here, but it came out of our bank account. So because of those two things, we lost $45,000 in cash. So in answer to the question, I made $61,500. How come I don't see it in my bank account by the end of the year? Is this. We only increased our cash by $8,500. So at the beginning of the year on January 1st, we had $22,000 in the bank. And at the end of the year on December 31st, we had $30,500, even though our income statement, our profit and loss statement told us that we had $61,500 in profit. It's because money left for all of these different reasons, or it stayed because of some reasons. And that's what this statement is doing for you. It's untangling all this so you can understand that where the cash is going. And as I mentioned, this is one of the top reasons that businesses fail. So it's really, really important to understand this concept of the fact that your profit and loss statement is not the thing that you should be looking at to figure out how much money is in your bank account. This statement is also looking at your past. So an SBDC advisor can help you look and do what are called cash flow projections into the future, especially if you're just starting your business. And what that will do is help you navigate and look to the future and say, 6 months down the road, I'm a seasonal business. 6 months down the road, I still have to pay my mortgage, but my business is closed. What am I going to do about that? Because I'm going to run out of cash. I had a situation like that. I had a seasonal business, a very, very large mortgage. And the way I managed that was to talk to my bank, and I was allowed to do my my mortgage payments during a 4-month period when I had the most cash. I had to do all of the payments for the year, but I did them in those 4 months because I was flush with cash then, versus the end of the year when my business isn't open. There's other ways that you can manage problems that arise with cash flow, like lines of credit. You can do a better job of getting money from your customers who haven't paid you yet. There's all kinds of things that you can do to manage cash flow, but that's looking into the future is one way to kind of map out what might happen. And then you don't want to go to your bank when you see that your bank balance is zero. You want to go to your bank 3 months before that happens so that you can say, I'm going to need a line of credit. So that is a statement of cash flows. And just to get to that final section there, remember, we only increased our cash $8,500 when we factor in everything that happened inside of our business. So this is the end of the presentation for all 3 of our financial statements. And as I said, please go back and look at the first 2. And just as a reminder, each report is telling you something different about the health of your tree if you consider your business like it's an apple tree. And the income statement is looking at the top part of that tree and your ability and your efficiency and your success in growing, harvesting, and selling apples on our apple tree. But that's just one part of the picture here. The second is that you need to understand the health of your tree trunk and whether it's growing over time or whether it's not growing. And if it's not going to be able to support the operations of growing those apples. And then finally, your cash flow statement is the statement that's telling you what's the stream of water like coming into the root system of your tree. And in this case, it means the cash of your business. And you need to know that too, so that you don't run out of water and the whole system just dies off. And as a final reminder, these are the reports that we use to actually make decisions in our business. We don't want to just look at them and put them away. We want to do the analysis to say, do I need to be thinking about increasing my prices? Are the cost of my materials going up or down? And is there something I can do with my vendors to change those prices if they're going up? Maybe I can order in different quantities, or maybe I need to find a new vendor. It helps us look at the efficiency of our labor. Are people overscheduled and they're not, you're spending too much on labor? That was a really big issue in my business, which was an inn and a restaurant, and restaurants have very low margins and very high costs for ingredients and labor, and you really have to manage those. Otherwise, you go out of business very quickly. And then these financial reports are going to help you know if you can take out a loan, or maybe you should be using equity, that retained earnings section of your balance sheet to reinvest in your assets, because you have to have assets to run your business. And it's going to help you know how sustainable and healthy you look to an outside person that you're trying to get money from. So that is the end of our 3 videos on financial statements. Please go to our website and check us out. We have all kinds of resources, including pre-recorded webinars on other topics like this. We have one-on-one business advising that you can sign up for. We have e-courses, blog posts, all kinds of things. Hope to see you there.